You retire, your paycheck stops. You expect your bills to shrink, and instead, you open your Medicare statement, and the number is higher than you expected. Not lower, higher. If that sounds backwards, here's why. Medicare isn't looking at what you earn today. It's looking at what you earned 2 years ago. Today we're talking about IRMAA, the income-related monthly adjustment amount. The extra charge that can quietly follow you into retirement based on decisions you already made. Welcome back to On My Watch. I'm your host, Dr. Riz, and my goal is simple. Cut through the confusion and help you make smarter healthcare decisions. If you watched my previous episode on working past 65, you already know that when and how you enroll in Medicare matters. Today we're going one level deeper. What happens to your Medicare bill once your income enters the picture? So what exactly is IRMAA? Not sure what is IRMAA? It stands for the income-related monthly adjustment amount. And despite the intimidating name, the idea is simple. It's an extra amount added on top of your normal Medicare premium, and it applies to two parts of Medicare. Part B, your medical coverage, and Part D, your prescription drug coverage. Only about 8% of people on Medicare actually pay it. But if you do, it's not small. That also means the other 92% pay the standard rate. If none of this applies to you, that's genuinely good news. But it's worth understanding anyway, because income can change. Unlike most of Medicare, IRMAA isn't based on your age, your health, or how long you've had coverage. It's based entirely on your income. If your income is above a certain threshold, Medicare charges you more. For most people, it comes out automatically, deducted right from your Social Security check, alongside your regular premium. And here's the part that trips people up the most. It's not based on the income you're earning right now. It's based on your tax return from 2 years ago. One more thing, there's a rule called hold harmless that protects your Part B premium. IRMAA is not covered by that protection. It's calculated and applied completely separately, and it can rise regardless of what your Social Security check does. This is the centerpiece of the whole episode, so let's slow down here. Medicare uses what's called a 2-year look back. Your 2026 Medicare premium isn't based on your 2026 income, it's based on your 2024 tax return. Your 2027 premium will be based on your 2025 income. Your 2028 premium on your 2026 income. Every single year, Medicare is looking exactly 2 years behind you, even while you're looking straight ahead. It works this way because tax returns take time to file and process. By the time your prior year's return is finalized, Medicare is already setting the next year's premiums, so it defaults to the most recent complete return it has, which is always about 2 years old. That gap is exactly why so many new retirees get blindsided. You retire, your income drops immediately, but Medicare hasn't caught up yet. It's still charging you based on the paycheck you were earning 2 years before you even stopped working. One more important distinction before we go further. IRMAA isn't based on your salary. Medicare doesn't just look at your paycheck. It uses something called Modified Adjusted Gross Income, or MAGI. So MAGI is essentially your total taxable income from your tax return plus any tax-exempt interest. That number can include your wages, bonuses, investment income, capital gains, IRA distributions, and even Roth conversions. So when people say, I don't make that much anymore, the real question isn't what you're earning today, it's what your full tax return showed 2 years ago. Let's put real numbers on this. For 2026, if your modified adjusted gross income from your 2024 tax return was $109,000 or less as an individual, or $218,000 or less filing jointly, you pay the standard Part B premium, $202.90 a month. Cross that line and you move into IRMAA territory, and it climbs in tiers, not gradually. Between $109,000 and $137,000 individually, or $218,000 to $274,000. Jointly, your Part B premium jumps to $284.10. The next tier, up to $171,000 individually or $342,000 jointly, is $405.80. Above that, up to $205,000 individually or $410,000 jointly, you're at $527.50 Beyond that, and under $500,000 individually or $750,000 jointly, it's $649.20. And at the very top, $500,000 or more individually, $750,000 or more jointly, the premium tops out at $689.90 a month. Part D, your drug coverage carries its own separate surcharge on the same income tiers, ranging from about $14.50 up to $91 a month. Added on top of whatever your specific drug plan already costs, one thing worth naming clearly, these aren't salary tiers, they are MAGI tiers. Two people with identical salaries can land in completely different brackets, depending on investment income, retirement account withdrawals, or one large one-time transaction. One more critical detail on those joint numbers. If you're married and both spouses are on Medicare, IRMAA is charged per person, not per household. A couple in that $649.20 tier isn't paying $649.20 combined. Each of them pays that amount separately. So it's really about $1,300 a month between the two of them for Part B alone. And a filing status footnote. If you're married but filed separately, the brackets work very differently. There's no middle cushion, and crossing $109,000 jumps you almost straight to the top tiers. If that's your situation, that's worth a conversation with a tax advisor before anything else. Let's do a case study. Meet David and Susan. Let's make this real with David. David is 65 and he's not slowing down. He keeps working through 66, 67, all the way to 68. At 68, he finally retires and enrolls in Medicare. Here's where it gets interesting. In 2024, while working full-time, David's modified adjusted gross income was $300,000. Now it's 2026. David has retired, his income has dropped significantly, but Medicare sends him a premium notice based on that $300,000 figure from 2024, because $300,000 falls in the tier above $205,000. David's Part B premium isn't the standard $202.90, it's $649.20 a month, more than 3 times the base rate. David's reaction is the one almost everyone has. Wait, I don't make that anymore. And he's right. But because of the 2-year look back, Medicare is still looking at the version of David's finances from 2 years earlier, not the retired version sitting in front of the mailbox today. This is exactly the trap. Your age doesn't reset the look back, and retiring doesn't automatically lower your bill the moment your paycheck stops. There's a real lag between when your income changes and when Medicare notices. David isn't the only version of this story. Consider Susan. Together, she and her husband had a household income of $220,000. When her husband passes away, Susan's own income doesn't drop by half. She may still receive a pension, required minimum distributions, and investment income that made up that household total. But now she files as single, and the individual threshold is roughly half the joint one. Income that was comfortably under the couple's threshold can push Susan well over the individual one, sometimes moving her into a much higher tier the very next year that gets used. Same look-back mechanic as David, completely different trigger. Now here's the twist that makes this actionable instead of just frustrating. Retirement is just one of several situations Social Security calls a life-changing event. The list also includes marriage, divorce or annulment, the death of a spouse, a reduction in work hours, not just stopping entirely, and the loss of pension income or income-producing property. If any of those genuinely change your income, you may be able to ask Social Security to reconsider your IRMAA determination using your current income instead of the 2-year-old figure through a form called SSA 44. That's worth distinguishing from a second different situation. Sometimes Social Security simply used the wrong tax return, an amended filing, an IRS correction, and your actual 2-year-old income was never what they think it was. That's not a life-changing event claim, it's a correction claim, and it uses a different process. Either way, none of this is automatic, you have to request it. So instead of simply accepting a higher premium because that's what the tax return showed, the real move is figure out which situation you're in and file the right request. This is the difference between quietly overpaying for a year or two and getting your premium corrected months sooner. you need to look out for Roth conversions and income spikes. This same look back creates a planning trap for anyone doing a Roth conversion, taking a large capital gain, or pulling a bigger than usual distribution from a retirement account. Say you convert $95,000 from a traditional IRA to a Roth in 1 year. That's often smart long-term tax planning, but that conversion adds directly to your modified adjusted gross income for that year. And 2 years later, Medicare uses that exact number to set your premium. A conversion that looked completely reasonable on your tax return can quietly push you into the next IRMAA Tier 2 years down the road. And remember, these are cliffs, not slopes. Crossing a threshold by even a few $1,000s triggers the entire next tier surcharge, not a partial one. The lesson isn't never do a Roth conversion, it's know where your major sits relative to the nearest IRMAA threshold before you pull the trigger. Because the bill doesn't show up until 2 years later when it's too late to undo it. Let's discuss the 6 IRMAA traps. Let's run through 6 IRMAA traps fast. Trap 1. I retired, so my premium should drop immediately. Not necessarily. The 2-year look back can create a real lag before it catches up. Trap 2. My salary determines my IRMAA. Not exactly, it's your modified adjusted gross income, which includes far more than just wages. Trap 3. I'm only slightly over the threshold, so it's not a big deal. Actually, that's often the most painful spot. Going from $205,000 to $206,000 in Maggie can jump your premium from $527.50 to $649.20 a month because you crossed into the next full tier. Trap 4. My income is high this year because I converted my IRA to a Roth. That can be a one-time spike, but it still affects your Medicare premium 2 years later. Trap 5. I'm 68, so I've already missed my chance to plan around this. You haven't. Your age doesn't eliminate the income planning window. Decisions you make this year still affect your premium 2 years from now. And trap 6, the one Susan just ran into. My household income was always comfortably under the threshold, so I'm fine. If you're widowed, that can change fast. Filing a single the next year against a threshold roughly half the joint amount, even though your income didn't drop by half, is one of the most common and least anticipated IRMAA surprises there is. Here are some takeaways. So what is Medicare's rearview mirror? Let's bring it all together. IRMAA isn't a penalty and it isn't random. It's simply Medicare charging higher earners more based on income from 2 years ago. The number on today's bill isn't a reflection of today's paycheck. It's a reflection of a tax return you already filed. Think of it this way. Medicare has a rearview mirror. Your 2026 premium is really your 2024 income looking back at you. If your income has genuinely dropped through retirement or another life-changing event, you may be able to request reconsideration. And if you're planning a Roth conversion, a large capital gain, or any unusual income spike, run the math against the current Maggi tiers first, because the bill arrives 2 years after the decision. If this made IRMAA click for you, please like the video and subscribe to the channel. Thank you for watching. I am your host, Dr. Riz. Stay informed, stay out of trouble, and I will see you in the next video.